As we began the development phase of the Risk Scorecard, we did exhaustive reviews of existing white papers, thought pieces, textbooks, and so forth associated with risk. And we began to see a huge overlap with other areas of management science that already exist. So terminologies were being presented in the risk world where we'd seen the same concept with a different title in other elements like Lean, Six Sigma, Balanced Scorecard, and so forth. So we'd like to explain some of the overlap that we've seen and what some of this terminology looks like. So if we take a look at your organization, over time you're going to try to plot your performance. And that is going to occur in things that you currently have, things like budgets and operational plans and so forth. Now, as you lay down those plans, you're also thinking of what are the thresholds you can operate above and below that level, which you're going to be comfortable with. You're not going to do anything different. So in the risk world, we call those thresholds the risk appetite. The idea is this. If you go below this performance to a certain level, you're going to get anxious. Or even if I go above that to a certain level, it may occur problems. So even if you take a look at something like sales, where you'd normally think, gosh, there could never possibly be too many sales. If you think of the recent release of the iPhone and the iPad, the demand was so huge that it began to cause downstream problems. Both technical support and customer service were unable to deal with the volume of business that was suddenly coming their way. So even a high value can be bad. Again, the risk appetite. Now, above that, there are performance levels that are going to cause even more grief. So at a certain level, it's going to be beyond what your organization can easily accommodate. You might now need to have special meetings, allocate resources, launch special projects, and so forth, both above and below the current performance levels. In the risk world, we call that the risk tolerance. And the idea is those are areas where the performance goes beyond what the organization can seamlessly absorb and special efforts need to be taken. Now, obviously, there's lines even above and below that. So that line where, as many good things that could possibly happen actually occur, but of course the opposite. What if everything bad could possibly happen as bad as it could occur? In the risk world, we call that the risk universe. And that's the total possible spectrum of what could occur in your business environment. So that's the risk terminology. Now let's overlay the planning stuff I was talking about before. So if you're doing a plan, that current performance is sort of your target. In this example, let's say we're planning to have 5,000 customers. Now, as you're planning, you might go, well, so long as customers are above 4,700 and below 5,600, we're okay. That's within tolerance of our business performance. That's called the risk appetite. Now, above that is what we call risk tolerance. So you might say, gosh, if we get fewer than 3,500 or over 7,000, we have to take drastic action, maybe as severe as leaving the market as an example. And that's, of course, the risk tolerance. So how do we deal with that? Well, traditionally in your business planning, the stuff that you call target, if you think of, say, a scorecard or dashboard where your indicator turns red, yellow, and green, green, you're meeting expectations, yellow, you're slightly off, and red, it's a crisis and we need to take special action. Target would be green. So effectively, that area called risk appetite is where we have our green measures. Risk appetite really is the yellow. It's within tolerance. We need to pay attention to it, but we're not going to take any heroic activity. That's the yellow band. And then finally, risk tolerance. That's what happens if it's a severe issue and it's all hands on deck. We need to solve this problem. And that's the red band. So what we're seeing is the traditional red, yellow, green bands. What does that mean as we compare and connect the risk thinking with the performance thinking? Well, two things. First, determining the process performance levels is obviously owned by the organization, the process owners and leadership. And these targets are going to inform us of the risk level, appetite, and tolerance. In other words, if you want to sort out your organization's risk appetite and tolerance, you actually have to start off with the processes. understand how those processes link back to the strategic objectives and the risk elements, and from that, you can determine the performance levels that your current resources allow you to generate, and from that, where your red, yellow, green risk appetite performance levels should be. Now, to connect a third concept, often when you're impacting the risk scoring activity, we give it a score of 1 to 5. 1 being minor, 2 being moderate, 3 major, 4 severe, and so forth. If we compare this back in that same framework, it looks a bit like this. So, that minor risk, that's sort of in the risk appetite range. What we had is the green range before. The moderate and major risks, those are really the risk tolerance levels, sort of the yellow and the red that we talked about. And then finally, the severe and catastrophic worse, that's sort of the red band that we talked about before. So there's a relationship between some of the terminology that you've heard before in the risk world and what you're used to seeing in the Lean Six Sigma scorecarding world.